John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hi there, John Ulzheimer here. Today I'm answering another viewer question. I love viewer questions. If y'all ever have any questions, drop them in the comment section below. I get a lot of ideas for content from questions I get from consumers. You know, it's a whole lot easier for me just kind of making up topics that I think you'll be interested in. So if you've got anything that you really want me to talk about, FAQ is usually a really good way to give me some ideas for more of this credit-related content. So today's question is from a viewer. And the question specifically is, are personal lines of credit or personal loans treated the same way by credit scoring systems as credit card accounts? Really good question. Very granular, which I like. I like these very granular types of questions about credit cards and the different things that impact credit scores and such. So the answer to the question regarding our personal loans or personal lines of credit treated differently than credit cards is yes, definitely. So on a credit report in the Metro 2 credit reporting language, that gives the furnisher, the company that reports information every month to the bureaus, the ability to be very precise with their information, meaning that when they report something to the credit bureaus, they're able to do so in such a way that clearly identifies the type of the account that it is that they're furnishing. So there is no confusion, meaning if a bank, which can extend a variety of lines of credit, credit cards, mortgages, auto loans, etc., furnishes something to the credit bureaus, rather than it just indicating that you have a bank account, can indicate very specifically that you have a mortgage, 30-year fixed rate mortgage with your monthly payment of whatever. So you can add, as a furnisher, a ton of precision with respect to anything that you're sending to the credit bureaus. And so that's important in the context of today's question, because when a credit card issuer or a bank that issues credit cards furnishes information to the credit bureaus, when they do so, it is very, very clear that the information they're reporting is about a credit card account. And why is that important? It's important because we know that credit cards are influential to credit scores very differently than, say, auto loans or personal loans or anything like that, because the credit card account is considered in that revolving utilization ratio, and then other metrics also that consider balances on credit cards and such. So absolutely, credit card accounts are considered very uniquely and specifically because they're marked as being credit card accounts. To the personal line, personal loans, I get this question from time to time about home equity lines of credit because they are in fact revolving accounts, because you can draw down from your HELOC limit, pay a little bit, carry a balance, pay it back, have the full amount available to you, draw down. It actually kind of smells like a credit card, but it's not. There's not a piece of plastic. It's secured by the equity in your home, where a credit card is not secured by equity in your home. But when you look at a credit report, they do both show up as revolving accounts. And so some people misconstrue that as meaning that the home equity line of credit is considered the same way as credit cards because they share the similarity of being revolving. But back to what I talked about a minute ago about the ability to report something with great precision, the same thing applies with home equity lines of credit or HELOCs. When the furnisher reports those to the credit bureaus, they absolutely show up as HELOCs, which means that credit scoring systems do not consider them in the revolving utilization ratio. That's a source of a lot of myths. A lot of people, bloggers and such, report incorrect information about that. And people get all freaked out if they max out their HELOC because they're doing a home improvement. They think their credit scores are going to tank, and that's not going to happen because credit scores don't consider those as part of the utilization ratio. And the same goes true for any other type of personal line or personal loan. They are reported again with that amount of precision that clearly identifies them as being personal loans and personal lines of credit. There are, in fact, for those of you who've been around the credit industry for a while, you may remember the signature loan, which was kind of what the personal loan was formally referred to as. Basically, you take out a small installment loan. It's not secured by anything other than your credit quality, and so that was called a signature loan. So those are, in fact, still offered today. I don't know that they're called signature loans any longer. They're just called personal loans. But there are tons of banks that offer personal loans, but they show up on credit reports as personal loans. Now, where there is similarity is payment history. If you default on any of that stuff, it's considered a default. If you pay it late, it's considered being paid late. And so in that respect, there is some similarity with respect to how things are being treated. So the answer to the question, yes, in some respects, no in other respects. So if you have any other questions about credit scoring and how they consider certain things, again, drop them in the comment section below. Have a great rest of your day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.